What if I told you that keeping $100,000 in the bank as a single Australian retiree costs you up to $44 a fortnight in lost age pension, not because the bank charges you, but because Centrelink's deeming rules treat that cash as if it's earning income you're not getting? That's not a hypothetical. That's a rule that's been sitting in the system quietly, taking money from people who did everything right, worked hard, saved carefully, and parked their money somewhere safe. And here's what makes it worse. Most financial advice tells you to keep 3 to 6 months of expenses in the bank. That's the standard line. It's not wrong exactly, but for a retiree receiving the age pension, it misses the number that actually matters. There's a threshold, a specific dollar figure. Once your cash balance crosses it, Centrelink assumes you're earning investment returns whether you are or not, and they reduce your pension accordingly. For a single retiree, that threshold is $64,200. Above that, every extra dollar you keep in the bank is quietly costing you pension. The penalty can reach $44 a fortnight. That's $1,144 a year. Not a fine, not a fee, just pension you're no longer receiving. Now, before we get to exactly what to do about it, let me show you how this deeming trap works in practice. Because the mechanism is simpler than it sounds, and once you see it, you'll understand why the 3 to 6 month rule was never designed for people like you. The deeming threshold for a single retiree, as at March 2026, is $64,200. Above that amount, Centrelink assumes your financial assets earn 3.25% per year. Below it, the rate is 1.25%. These aren't the rates your bank actually pays you. They're the rates the government says you're earning, regardless of reality. That assumed income, called deemed income, gets added to any other income you receive. And once your total income crosses the income test-free area, your age pension is reduced by 50 cents for every dollar above it. For a single retiree with significant cash savings, the maximum reduction from deeming alone can reach around $44 a fortnight. Over a full year, that's $1,144 of pension gone. I want you to meet Margaret. She's 63, a retired nurse, and she inherited $150,000 from her mother's estate last year. She didn't want to invest it, not because she's careless, but because she's sensible. She's seen markets drop. She doesn't want to lose what her mother left behind. So she put it in a savings account. It felt like the right thing to do. Margaret receives part of the age pension, and she has no idea that her $150,000 sitting in the bank is costing her pension every fortnight. No letter arrived, no warning. It just happened automatically the moment her financial assets were assessed. Here's how the mechanics work. On the first $64,200 of her assets, Centrelink deems her to earn 1.25% per year. On everything above that, the remaining $85,800, it deems her to earn 3.25%. Whether her bank actually pays her 0.5% or 5% makes no difference to Centrelink. The deemed income is fixed by formula. That total deemed income gets stacked on top of any other income she has. And as her total income rises above the free area threshold, her pension is reduced. Margaret is losing hundreds of dollars a year in pension, not because of what she spent, not because of market losses, but because of where her money is sitting. The advice she received before retiring was, keep 3 to 6 months of expenses in the bank for emergencies. That's solid general advice for someone still working. For someone on the age pension, it ignores a rule that has been quietly reducing retiree income for years. And here's the part that stings. The people most likely to be caught by this are the ones who are most careful with money. If you're the type of person who saves diligently, who doesn't splurge, who holds on to a cash reserve because it feels responsible, the system is treating that discipline as income. Your caution is costing you. There's no judgment in that. If you're over 55 and have any cash outside super, you may be in this exact position. The rule isn't designed to punish you, but it does penalize cash accumulation in a way that most people find out about only after the pension reduction has already happened. So now you know the trap. The question is what to do about it. But before we get to the solution, there's a second cost happening in the background, one that doesn't show up in your bank balance, doesn't trigger a Centrelink letter, and has been quietly eroding the real value of Margaret's $150,000 every single year. It's inflation. And the numbers might surprise you. While Margaret's $150,000 sits in her savings account, something is happening to it that doesn't show on her screen. The number stays the same. But what it can buy is shrinking. Annual inflation in Australia, as measured by the Consumer Price Index to February 2026, was 3.7%. That might sound manageable. But on $150,000, a 3.7% erosion in purchasing power means Margaret is effectively losing around $5,550 of buying power every year, even if she never spends a single cent. Stretch that out over 5 years. Assuming inflation holds at 3.7% per year, which is not guaranteed, but it's the current official rate, the purchasing power of that $150,000 drops to roughly $124,000 in today's terms. Not in the account balance, in what the money can actually do. That gap, $26,000, didn't go anywhere obvious. Nobody took it. There was no crash. The balance never dropped. But the cost of everything else went up. Council rates, electricity bills, car registration, Medicare gap payments, all moving in one direction, and the $150,000 is standing still. Now, older Australians often feel the effects of inflation harder than the headline number suggests. Healthcare costs, private health insurance premiums, and utility bills tend to rise faster than general CPI. So the real erosion for someone in their 60s could be higher than 3.7%. We'll use the official figure because it's what we can verify, but know that 3.7% is probably the floor, not the ceiling. I'll reference history briefly. In the 1970s, inflation in Australia hit double digits. Not for 1 year, for years in a row. We're not there now. But even a modest, sustained rate of 3.7% is enough to cut the real value of a retirement nest egg by more than 15% in 5 years. That's without a single bad investment. For Margaret, this means $150,000 in the bank is not a safe floor. It's a slowly sinking platform. And here's the thing, the instinct to protect that money by keeping it in cash is completely understandable. But moving it all into investments comes with its own serious risk. One that, for retirees specifically, can cause permanent damage. That's what we need to talk about next. Here's the part that surprises most people. After everything I just told you about inflation and deeming penalties, the answer is not to move all your cash into investments. Not if you're retiring soon. Not if you're already retired. I used to think holding more than 6 months of expenses in cash was a waste. I was wrong. After seeing what happened to retirees who had to sell their investment portfolios during the 2020 crash, I changed my mind. People who had no cash buffer were forced to sell shares at the worst possible time, locking in permanent losses. People who had 2 to 3 years of living expenses in cash, they didn't have to sell anything. They waited. The market recovered. Their portfolios came back. That's not luck. That's a strategy. The risk that forces early selling has a name, sequence of returns risk. It's what happens when markets fall early in your retirement, before your portfolio has had time to grow. A 20% market drop in year 1 of retirement is far more damaging than the same drop in year 15 because you're drawing income from a shrinking base. And once those units are sold, they're gone. You don't benefit from the recovery the same way. A cash buffer of 2 to 3 years of essential living expenses protects against exactly this. It means that when markets fall, and they will fall, You don't have to touch your growth portfolio. You live off the cash, you wait, and your investments recover on their own timeline. Think of it this way. Margaret's essential living expenses are roughly $40,000 a year. A 2-year buffer is $80,000. A 3-year buffer is $120,000. That cash stays in a high-interest savings account or spread across term deposits, not sitting idle, but not exposed to share market movement either. The $30,000 above her buffer, the part she doesn't need for day-to-day protection, is what goes to work into a conservative growth portfolio, or into super if she's still eligible to contribute. This is what I now think of as the 3-bucket structure. Bucket 1, 1 to 2 months of operating cash, what you need for bills and groceries. Bucket 2, 2 to 3 years of essential expenses, the buffer that protects your growth assets. Bucket 3, everything above that, invested for the long run. The insight here is that the second bucket isn't lazy money. It's insurance. And like all insurance, it costs a small premium. In this case, that premium is the difference between a high-interest savings rate and a growth portfolio return. For the protection it provides, most retirees find that a fair deal. There's still the deeming question. With $120,000 in the bank instead of $150,000, Margaret's deeming exposure is lower, and the $30,000 moved into super, in pension phase, is not subject to the same deeming calculation at all. So the bucket approach doesn't just protect her from sequence of returns risk. It also eases her pension reduction. But what's the actual number? How much is too much? Let's put the full picture together. So how much should you actually keep in your bank account? Start with your essential living expenses, not your total spending, just the necessities. Rent or mortgage, utilities, groceries, medical costs, insurance, transport. Leave out holidays, gifts, and the things you'd cut first if money got tight. Be honest about what the floor actually looks like. Once you have that number, multiply it by 2 or 3. That's your cash buffer target. For most single retirees, with essential expenses around $40,000 a year, that puts the buffer somewhere between $80,000 and $120,000. Now, compare that buffer to the deeming threshold. As a single retiree, the lower deeming rate applies to the first $64,200. Above that, the higher rate applies. So if your buffer sits at $80,000 to $120,000, some of it is going to be subject to the higher deemed rate. That's not necessarily a problem. It just means the buffer has a cost. And part of the goal is to keep that cost as low as possible by not holding more than you need. The second thing to check, if you have more than $250,000 in cash at any one institution, split it. The Australian government's financial claims scheme guarantees up to $250,000 per account holder per institution. That's the safety net, not the ideal balance, but the protection limit. Most people stop at step 1. They figure out they need a buffer. They feel satisfied knowing it's there, and the rest of the cash never moves. That's where the real cost accumulates. Margaret has $150,000 in the bank. Her buffer is $120,000. The extra $30,000 is not part of the safety net. It's just sitting there earning 0.5% in a transaction account. If that $30,000 went into a conservative growth portfolio, earning 6% per year, it becomes $53,725 over 10 years. Left in the bank at 0.5%, it grows to $31,534. The difference is over $22,000. And that doesn't account for the deeming reduction she'd also gain. The surplus above your buffer is the part that's working against you twice, earning less than inflation and triggering a higher pension reduction. That's where the decision matters. Now, knowing the numbers is one thing. Acting on them is something else entirely. And there's a reason most people don't. You work for decades to build that balance. And when you look at a number sitting in your bank account, there's something about it that feels solid, real, safe. The number doesn't change. It just sits there. That feeling has a name: loss aversion. Research in behavioral finance has shown consistently that people feel the pain of a potential loss roughly twice as strongly as the pleasure of an equivalent gain. Moving money from a savings account to an investment portfolio feels like standing at the edge of a cliff, even when, objectively, leaving it in the bank is the guaranteed slow loss. I'll be honest, I dragged my feet on this myself. I had a chunk of money sitting in a savings account for nearly 2 years because I couldn't make a decision. Part of me felt like not deciding was safe. It wasn't. Eventually, I moved half into a balanced fund. I should have done it sooner. No shame in taking your time. But at some point, taking your time becomes costing yourself money. The good news is, you don't have to move everything at once. If the buffer is right, you only need to move the surplus. For most people, that's a smaller number than they expect. Start with something manageable. Move enough to feel the decision in a real way, but not so much that you lose sleep over it. One step is enough to break the pattern, and once you've done it, the second step is easier. Let's bring the whole picture together. If you're a single retiree, the deeming threshold is $64,200. Above that, Centrelink treats your financial assets as if they're earning more than they might be, and that reduces your age pension. The maximum reduction from deeming alone can reach around $44 a fortnight. The right amount of cash to hold isn't based on what Centrelink allows. It's based on your own essential living costs. 2 to 3 years of expenses, kept in a high-interest account, is what protects your investment portfolio from being sold at the wrong time. Anything above the buffer is working against you. It earns less than inflation and triggers more deeming. Move it. If you're coming up on retirement and you want to make sure your cash is working for you, not against you, subscribe to the channel. I put out new strategies every week for Aussies at exactly this stage of life. You don't have to be an investment genius to retire well. You just need to know the rules of the game. And now you do.